The stock market is constantly evolving, and today is no exception. Buckle up for some wild market moves, but also for some surprising investment insights. Ever wonder why tech giants like Apple are thriving even in uncertain times? Or how everyday expenses can eat into your savings goals? We're diving into these topics and more. Plus, we have a special surprise that could potentially boost your savings by 20%. But first, let's check out which stocks are making the biggest moves today. Investors are going wild over the sudden surge in shares like Tesla, United Airlines, Netflix, and JD.com. These stocks have seen massive price jumps today, so what's driving this excitement? Is it groundbreaking new products, stellar earnings reports, or something else entirely? We'll unpack the reasons behind these stock surges. Next, let's talk about one of my favorite topics, practical investing tips. Today we're diving deep into why superstar investors like Warren Buffett swear by the power of compound interest. Imagine starting with just $10 and turning it into over $267,000. Yes, you heard that right. It's not a fantasy, it's math. We'll reveal how long it takes to reach this financial milestone and the factors that can accelerate your journey. But before we dive into those juicy details, remember to hit that subscribe button. It's free, it's quick, and it means you won't miss any of our exciting videos. Also, be sure to stay until the end because we've got a special treat for you that could save you thousands. Now, let's turn our attention to the banking giant JP Morgan. They've made headlines with an unexpected announcement that might leave some of you scratching your heads. They're slashing interest rates on their savings accounts. This move has sparked quite a bit of curiosity. Why would they do this when other banks are increasing rates to attract customers? We'll explore the potential reasons behind this decision and what it might signal for the broader economic landscape. For those of you who love numbers and data, get ready to dive into a treasure trove of financial insights. We've rounded up the top 10 money movers for the day, from stocks making record highs to economic indicators that are shifting the market. No detail is too small. Whether you're a seasoned investor or just starting your financial journey, these figures will provide valuable insights into the trends shaping the market today. So if you're someone who thrives on data and loves to stay ahead of the curve, make sure to stick around. We'll walk you through each number, explaining its significance and how it's influencing the markets. It's time to pull back the curtain and unveil the most secretive investment strategy employed by the legendary Warren Buffett. Known as the Oracle of Omaha, Buffett has built a remarkable investment portfolio over the years, amassing a fortune while guiding his company, Berkshire Hathaway, to unparalleled success. So what sets his approach apart from other investors? We'll break down the key elements of Warren Buffett's investment strategy, offering a glimpse into the mindset and principles that have made him one of the most successful investors of all time. Imagine being able to predict market fluctuations with an uncanny precision, buying low and selling high, consistently making profitable investment decisions. The allure of mastering this skill is undeniable, and now you have the opportunity to learn from the best. Get ready to unlock the secrets of successful trading by mastering these proven techniques. You'll gain the confidence to navigate market ups and downs, capitalize on lucrative opportunities, and make informed investment choices. Whether you're a novice investor or an experienced trader, this knowledge will be invaluable. So if you're eager to sharpen your skills and up your trading game, stay tuned. We'll delve into the specifics of these techniques, providing you with practical knowledge that you can apply to your own investment journey. Have you ever wondered why certain stocks seem to defy market downturns and continue to climb even when the overall market is in decline? That's precisely what's happening with tech giant Apple. Despite the challenges faced by many companies, Apple's stock continues to reach new heights. So what's driving this resilience and sustained growth? Well, Apple's success can be attributed to several key factors. Firstly, they've cultivated a strong ecosystem of products and services that keep customers within their ecosystem, encouraging repeat purchases and brand loyalty. Secondly, Apple has a reputation for innovation, consistently introducing cutting-edge products that cater to the evolving needs of consumers. Their sleek designs and user-friendly interfaces have made them a desirable brand in the tech industry. Moreover, Apple has a loyal customer base that trusts and values their products. This trust has been built over years of delivering high-quality goods and providing excellent customer service. Lastly, Apple's strong financial performance and prudent management contribute to its stability and growth. They have a history of generating strong revenue and profits, allowing them to invest in research and development, acquire new technologies, and reward shareholders. However, it's important to acknowledge that Apple's success is not without its critics. Some argue that the company's dominance in the tech industry stifles competition and limits consumer choice. Others criticize Apple's high product prices and limited repair options, viewing them as anti-consumer practices. Additionally, concerns have been raised about Apple's labor practices and working conditions in their supply chain. Despite these criticisms, Apple's resilience during market downturns and its ability to maintain growth are noteworthy. While no company is immune to economic challenges, Apple's strong fundamentals, loyal customer base, and innovative spirit have enabled it to weather the storm and emerge stronger than ever. Ever pondered about the strategies adopted by legendary investors to navigate the unpredictable world of finance and secure their financial success? Look no further than Mohamed El-Erian, the chief economic advisor at Alliance. He's a renowned figure in the industry, and he holds some intriguing insights to share about the tactics employed by successful investors. According to El-Erian, one of the key strategies employed by these investors is maintaining a balanced portfolio across various asset classes. They understand the importance of diversification in mitigating risks and maximizing returns. By spreading their investments across different sectors and asset types, these investors aim to reduce volatility and enhance their overall portfolio resilience. Another strategy highlighted by El-Erian is the practice of dollar-cost averaging, which involves investing a fixed amount of money at regular intervals regardless of market conditions. This approach allows investors to buy more shares when prices are low and fewer shares when prices are high, averaging out the purchase price over time. According to the legendary investor Charlie Munger, dollar-cost averaging can be a highly effective strategy for long-term investors, helping them to avoid emotional decision-making and capitalize on market fluctuations. El-Erian also emphasizes the significance of adopting a patient and disciplined investment approach. Successful investors understand the importance of waiting for the right opportunities and avoiding impulsive decisions driven by market sentiment or short-term trends. Patience allows them to identify undervalued assets and position themselves for long-term gains. Lastly, El-Erian points to the value of staying informed and conducting thorough research. Seasoned investors dedicate considerable time and effort to understanding market dynamics, analyzing financial data, and assessing investment prospects. They continuously educate themselves and stay updated with the latest economic and industry developments to make well-informed investment choices. By implementing these strategies, investors can enhance their financial resilience, maximize returns, and position themselves for long-term success in the dynamic world of finance. In a shocking turn of events, JP Morgan, one of the nation's leading banks, has decided to slash interest rates on its flagship high-yield savings account. This move bucks the current trend among banks that are increasing rates to attract customers and has left many wondering about JP Morgan's rationale behind this surprising decision. The bank's national advertisement for the one-year term deposit is currently offering a 4.5% rate, with the 6-month rate standing at 4%. However, come September, these rates will drop to 3.75% and 3% respectively. This reduction in interest rates is particularly noteworthy as other major banks, such as Bank of America, Wells Fargo, and PNC, are raising their rates to remain competitive and attractive to savers. So what prompted JP Morgan to take this seemingly counterintuitive step? One possible explanation lies in the bank's assessment of market conditions and future projections. JP Morgan may believe that interest rates are nearing their peak and are unlikely to rise further, reducing the need for higher rates to incentivize savers. Additionally, the bank may be focusing on attracting a different segment of customers, such as institutional investors or large corporations that prioritize stability and security over high-yielding investments. Furthermore, JP Morgan's decision may be influenced by its overall financial strategy and risk appetite. As a large, well-established institution, the bank may have a higher tolerance for lower yields on its savings accounts as it seeks to balance profitability with risk management and regulatory requirements. Regardless of the reasons behind JP Morgan's decision, this move highlights the dynamic nature of the banking industry and the various factors that influence financial institutions' strategies. It remains to be seen whether other banks will follow suit or if JP Morgan's decision is an isolated one. If you want to save 20%, listen up. you can increase your savings by 20% just by avoiding unnecessary expenses. Let's start with a simple example. If you spend $5 a day on coffee, that's $350 a year. Instead, imagine brewing your coffee at home, saving yourself both money and time. Over the course of a year, you could have saved $350. And the best part? It's just the beginning. Now consider another scenario. Are you guilty of impulse buying clothes or gadgets? Stop right there. By resisting those urges and shopping consciously, you can save a significant amount. Let's say you resist the urge to buy new clothes every month, spending only what you need to on clothing. After a year, you might have saved an additional $500. And don't forget the sneaky expenses that eat away at your savings. We're talking about subscription services that you barely use. Take a moment to review your subscriptions and identify those that provide minimal value. Canceling or pausing them can free up your cash flow and allow you to save more aggressively. If you cut back on just one subscription costing $15 a month, that's $180 you can save in a year. Transportation costs can also be a major drain on your finances. Gas, car maintenance, and parking fees can quickly add up. Consider exploring alternative modes of transportation such as cycling or using public transit whenever possible. Carpooling or ride-sharing services can also help reduce costs. By minimizing your transportation expenses, you can allocate more money towards your savings goals. By implementing these simple strategies and remaining vigilant against unnecessary expenses, you can significantly boost your savings rate and pave the way for financial success. Remember, every small step counts, and over time, these minor adjustments can lead to substantial results. Start today and watch your savings grow.